Most people believe investing is a test of intelligence. They think the smartest analysis wins, the best forecast, the sharpest insight. It is not. Over long periods of time, investing is a test of emotional control. Markets do not punish people for being uninformed as consistently as they punish people for being emotional. Fear, excitement, impatience, regret, the urge to act. These forces quietly erode returns year after year, often without the investor realizing what is happening. The Stoics understood this problem long before modern markets existed. They lived in a world filled with uncertainty, political instability, sudden loss, random outcomes, no guarantees. And instead of trying to control events, they trained themselves to control responses. This is the foundation of Stoic investing. You cannot control markets. You cannot control prices. You cannot control timing. You can control behavior. In volatile markets, this single distinction separates investors who compound wealth from those who compound mistakes. Stoic investing is not passive. It is disciplined. It begins with an uncomfortable realization. Your emotions are not signals. They are liabilities. When prices rise quickly, excitement feels like insight. When prices fall sharply, fear feels like protection. Both feelings are convincing. Both are wrong. The market does not reward emotion. It rewards consistency. Stoic habits are not about predicting what will happen next. They are about remaining functional no matter what happens next. The first Stoic habit is pre-commitment. Before volatility arrives, before headlines turn alarming, before emotions are involved, the Stoic investor decides in advance how to respond. What will I do if markets fall 20%? What will I do if they fall 40%? What will I do if prices stagnate for years? What will I do if optimism disappears? These decisions are made in calm, not in crisis. Most investors wait until emotions are already elevated before deciding. At that point, choice is an illusion. The nervous system is already in control. Pre-commitment removes decision-making at the worst possible moment, and that is precisely why it works. The second Stoic habit is negative visualization. The Stoics regularly imagined loss, not to invite fear, but to remove surprise. They understood that shock is more dangerous than pain. When investors refuse to imagine drawdowns, volatility feels like betrayal when it arrives. Shock sets in. Shock creates urgency. Urgency leads to selling. Selling locks in losses that patience would have healed. When you expect volatility, it loses its power over you. A portfolio that declines exactly as expected does not feel like failure. It feels like confirmation. Stoicism replaces hope with preparation, and preparation is calming. The third habit is ruthless focus on what is controllable. You cannot control market cycles, interest rates, economic slowdowns, political decisions, investor sentiment. You can control asset allocation, savings rate, diversification, rebalancing discipline, time horizon. Everything else is noise. Emotional investors argue with reality. Stoic investors adapt to it. They do not waste energy on prediction. They allocate energy to structure. The fourth Stoic habit is delayed response. Modern markets reward speed. React faster, trade quicker, adjust immediately. Technology amplifies this impulse. Prices update constantly. News never stops. Stoicism teaches restraint. Delay is not weakness. Delay is strength. Time filters emotion from information. When fear spikes, Stoic investors wait. They do not react to the first impulse. They let the nervous system settle. This is not inactivity. It is control. Most catastrophic mistakes happen in the first emotional hour, not in the 10th rational day. The fifth Stoic habit is identity separation. Stoics never tied outcomes to self-worth. Investors frequently do. A losing position feels like personal failure. A winning trade feels like proof of intelligence. This emotional fusion makes selling painful and holding reckless. It turns portfolios into reflections of ego. Stoic investors treat positions as tools, not judgments. Losses are information, not verdicts. This habit alone prevents irreversible damage. The sixth Stoic habit is accepting volatility as payment. Volatility is not a flaw in markets. It is the admission price. People who demand comfort pay for it with lower returns. People who accept discomfort earn compounding. Stoics do not seek calm markets. They seek calm behavior within unstable markets. When volatility is expected, it becomes tolerable, sometimes even boring. The seventh habit is expanding time perspective. Markets reward decades. Emotions operate in days. Stoic investors stretch their view until daily movement becomes irrelevant. When time horizon expands, urgency collapses. This is why long-term investors experience less stress, not because risk disappears, but because context increases. Stoicism does not eliminate fear. It puts fear in its proper place. The eighth habit is rule-based behavior. Stoics valued principles over impulse. Investors need the same structure. Rebalancing rules, contribution schedules, allocation bands. Rules remove discretion when emotions are loud. Discipline is easier when choice is limited. This is how Stoic investors remain consistent while others oscillate. The ninth habit is emotional humility. Stoics accepted that they were fallible. Investors often assume confidence equals competence. Overconfidence invites concentration. Concentration magnifies mistakes. Stoic investors assume they can be wrong, and they build portfolios that survive being wrong. Humility protects capital. The 10th habit is selective attention. Stoics were careful about what they consumed. Investors must be the same. News is designed to provoke emotion. Fear sells. Urgency spreads. Stoic investors limit exposure to noise. What you ignore matters as much as what you analyze. Less information often leads to better decisions. The 11th habit is emotional accounting. Stoics separated effort from outcome. Investors should do the same. You judge decisions by process, not result. Good decisions can lose money. Bad decisions can make money. Only process compounds reliably. This protects against false lessons. The 12th habit is acceptance of randomness. Markets contain luck. No strategy removes it. Stoic investors do not confuse randomness with skill. They remain steady through both wins and losses. This steadiness is rare and valuable. The 13th habit is endurance. Stoicism is built for long struggles. So is investing. Years of boredom, periods of drawdown, long stretches without validation. Most people quit here. Stoic investors endure, and endurance compounds. This is where wealth quietly forms. Now consider the cost of one emotional decision. Not a pattern, not years of mistakes, just one. One moment where fear overrides structure. One decision made to stop the discomfort. It often happens during stress, a sharp drop, a frightening headline, a sense that this time is different. The emotional investor sells to feel relief, and relief arrives immediately. The anxiety fades, the tension releases, the mind feels safe again. But the cost is delayed. Weeks later, prices stabilize. Months later, recovery begins. Years later, the gap becomes visible. The market did not punish the investor instantly. It simply excluded them from the rebound. This is the hidden cost of one emotional decision. Not the loss itself, but the lost participation. Some investors never re-enter. Fear replaces patience. Cash feels safer than uncertainty. Others re-enter late, after confidence returns, after prices rise. The damage compounds quietly. One emotional exit can overwhelm years of discipline. The same applies to euphoria. One moment of overconfidence, one concentrated bet, one belief that rules no longer apply. It feels earned, it feels rational, it feels deserved, until volatility returns. Stoic investors design their process to survive a single bad day. They assume emotion will appear. They assume weakness will surface. And they build guardrails. Stoicism is not about never feeling emotion. It is about never letting emotion decide. This is why discipline matters more than brilliance. Markets will fluctuate. Crises will repeat. Predictions will fail. Stoic habits act as insulation. They do not maximize short-term gains. They minimize irreversible errors. Over decades, that difference matters more than intelligence. If you master emotional investing, you do not need perfect timing. You do not need forecasts. You do not need constant action. You need structure, rules, patience. Stoicism turns volatility from an enemy into background noise. That is how capital survives storms. Not through prediction, but through discipline.